Awesome. Well, hello everybody. This is Bryce Headley. Thrilled to be with you as part of this Friendsgiving celebration. It's a great time of year to definitely take some stock or some options, as the case may be, into how the year's gone and what we're thankful for, and also what opens us up to some new opportunities as well. As our prior speaker was talking about, I think it's important to not just kind of let go of some stuff that if it didn't go right, but also to kind of get yourself into the right mindset, which for me, there's a couple of mindsets you can be in trading. You can be in multiple mindsets, of course, but the couple that I boil it down to is, are you in problem mode, dealing with past problems, past losses, past issues? Or are you in opportunity mode? Are you freed up, not just psychologically, but financially into the next opportunity, the next moment, and not stuck in the past? And this includes how you manage your existing trades so you don't get left with baggage. You don't get left with stuff that's not producing for you or that you just don't see fitting the pattern of success. And so everything I want to share with you today is tied into just a few key patterns we look at on just one name, Tesla, TSLA. And we love to trade quick options on Tesla from one trading day to the next and looking for these patterns for success, but knowing we're going to clean them up by the end of the next trading day. Okay, we're not going to get stuck drinking the Kool-Aid, drinking the optimism of the great stuff to come for many months or years ahead for Tesla. That's not our game. So a big part of the game is knowing kind of how you operate on the way in and also how you operate to clean them up, win, lose, or draw on the way out. Okay, so that's a big part of then freeing you up for the next opportunity, right? Because there's going to be wins, there's going to be losses. That's just a part of the game. It's part of life. There's ups, there's downs. Sometimes you're the windshield, sometimes you're the bug, as the song goes, the saying goes. But the idea is that as long as you can set trades up to where you can lose less on average than what you're making on average, and have a reasonable win rate. You don't have to have a massive win rate if you can just have bigger winners and relatively smaller losses, right? So that's what we're going to talk about. So that's kind of, I definitely like the psychology theme of overviewing everything, as even as we talk about technical patterns and charts, that you do have to kind of have your mindset right, whatever you're doing in trading and investing, right? And knowing where your edge is, where your bread is buttered, and when that window closes, you get rid of that trade. You close that out so you're not stuck in a past issue when you get into the next day and trying to clean up something else that you should have already cleaned up. Okay. So let's get on into new opportunities here and remind you as we get started that the information provided in today's presentation is based on our proprietary research. It's intended for illustrative purposes only. What we're talking about here should not be considered as specific advisory recommendations. As you know, stock and options trading have large potential rewards, but let's face it, they've also got large potential risk. We're going to talk about how we manage both sides of the coin here on each and every trade. And remember, the past performance of any trading system or method is not necessarily indicative of its future results. We all know future results are going to vary. What cannot vary is our commitment to following a system and a methodology. You've got to be committed 100%. When it's time to get out, even when it's a loss, you take it. When it's a winner, you take it. Basically, you find your rules, you find what your patterns are, and you don't get greedy, you don't get fearful. You just say, I'm just going to execute. So that's why so many people come to big trends now on our 26th full year anniversary here this month, having launched the company back in November of 1999, looking for that consistency of execution. So we're just going to use weekly options on Tesla, TSLA. Of course, there's a lot of big name stocks that have weekly options. You hear a lot of people talking about zero DT, 0 days to expiration as a path to wealth. I've messed with it some, but the reality is in my 36 years of options trading, I found that zero DTs are probably too volatile even for myself, but especially for most traders out there where you just have too many things that can kind of just really quickly turn on you. We need a little more breathing room, a little more staying power in the options time frame that we're going to buy. So we're going to give ourselves multiple days before expiration. Typically, we're not going to want to hold a trade into an expiration day on any weekly option on Tesla. So we'll show you a bunch of chart examples, success stories, and when it works, also when it doesn't, how we clean them up and move them on. And it's focus only on Tesla, right? So I don't know about you, but the biggest challenge I face in the markets and frankly in the world these days is information overload, right? You've got so many things coming at you and I've got so many coming at me that we have to really drill down and say, I'm gonna put the blinders on. I'm come from the thoroughbred background here in Kentucky, or if a horse has trouble focusing, they put blinders on it so it can only really see forward. It can't see left or right. It's going to stay focused on the goal, which is get to the finish line first, right? And so the idea here is that when you can say, I'm just going to focus on one vehicle like Tesla, which of course is so active, so news driven, can move so quickly. And if it's not right, we're going to wait, right? We're not always going to trade every day. We're going to pick our spots. And so the idea becomes, okay, how can we get focused on just one vehicle, reduce a lot of the noise, reduce a lot of the distraction, and frankly, reduce a lot of the stress of thinking, oh, there's hundreds of stocks moving right now. There's even thousands of stocks moving. Hundreds and hundreds of them are really active optionable stocks, right? I could trade options on so many things. What do I do? Well, that creates a whole lot of stress, wondering, okay, you feel like you're missing out. You feel like, do you have the right strategy in place? Do you have the right focus? Do you have the everything lined up to be successful, right? And you feel all those kind of pressure points, and so by focusing on just one vehicle makes your job and your life a lot less stressful, a lot easier. If you don't know me, I've been trading options for 36 years. I got the trading bug when I was a student at Duke University, and after graduating from Duke, kind of cut my teeth in the 90s with what was the nation's largest options newsletter at the time, and then launched BigTrends.com in 1999, now on our full 26-year anniversary this month. A lot of you all I know have been big trenders over the past. I'm thankful for each and every one who's contributed to Big Trends and supported us in this process of getting the word out about key bigger opportunities, right? Not getting stuck in that micro, too short term, too small of a thinking, looking for bigger moves that can give us meaningful results over time. Everything we do at Big Trends is based on a systematic approach, right? It's nothing seat of the pants, nothing based on my opinion, how I woke up feeling this day, good or bad, right? It's like, no, we've got to be very objective, quantitative, and not subjective in any which way. So let's get right into it, talk about a winning trade example, then we'll get into more details about how the strategy works. So we're just looking at the daily charts here on Tesla. Okay. So one of the first things you see on this candle chart, of course, candles where a red candle means we close below where we open. A white open body candle there with the green shading around it is a higher close compared to where we open. But you can also see that there's a moving average here. And again, I can't give away all the settings, but I can get the principles in for you here. And then when you become a subscriber, which I've got a great Friendsgiving special for you at the end, that will show you how you can try it out and let the system prove it to you. Don't just take my word for it. But MA means moving average. As you know, a moving average, if it's in this case a simple moving average, just averages the last however many bars back closes you want to look at. You hear a lot of times about a 200-day moving average. That's a very popular longer term one. We're looking at definitely a shorter one than that here, but definitely something that's not too short. So we want to smooth out some of the day-to-day fluctuations and say, which way has Tesla been going overall? When you're above the moving average, you've been generally trending higher. If you're below it, you've been generally more than not trending lower. So you're basically saying, okay, I only want to take short-term day-to-day trades on Tesla in the same direction as the intermediate term moving average filter here in light blue. So right away, I know none of those red bars are actionable. No, there's no short opportunities here. There's no put buying opportunities betting on the downside. It's only going to be a call buying opportunity. What we do is we also look at momentum on a day-to-day basis, right? So we like to see not only higher closes, but we also like to see that it actually showed us, a nice finish compared to where it was um, intraday, right? You can see in this example here on Tesla back on September 30th, just over a month ago now, you can see that it had traded lower compared to where it had been the day before, right? You saw how we had that little lower low, but then we had that nice reversal back up to finish right near the highs there. Um, what my late friend Steve Bigelow called the J hook. That basically it's like that flush of some of the other people who put their stops below the prior day's low. They get stopped out lower, and then the stock reverses and closes at the end of the day higher. We love to see that kind of a flush and reversal pattern as one of the techniques you can see. And then you can see, so what are we doing at the end of the day? Typically in about the last anywhere from 15 to 30 minutes of the trading day, we'll send a real-time alert to subscribers when we get one of these patterns. Why do we wait so long right near the end of the day? We want to make sure we're getting the end of the day being the true setup pattern. If you overreact, say Tesla gapped up, or gapped down, however it was, right off the open. If you overreact off the open, you can easily get faked out by the end of the day, right? The end of the day is much more what I often say is the much more telling. The first hour is often called amateur hour because a lot of traders will put the newer traders will put their stops right off of say a prior key low or high. And then at the same time, the last hour is typically where a lot of the pros and the big institutions are looking for what's the tonality of how Tesla is doing. Today the stock opened a little higher, by the way, on Tesla, and then quickly popped back down, right? The market took a quick little reversal down before starting to build back up here now. And so, we had closed yesterday at 444. We opened at 452, then we're quickly back to 440, right? And so it's one of those that sits right now about Tesla sits about 447, up about 2.5 points right now. But the point of it is that okay, and that hasn't moved that much in the last 4 or 5 weeks, right? From where we were in late September. Doesn't matter. What we look at is what's the pattern day to day, right? So we were liking this entry here right near the end of the day. So we told subscribers in that final half hour or so of the trading day on September 30th to buy the options that were going to expire that coming Friday. That was October 3rd, is the week first Friday is called the week one expiration in October. And so in that case, we said, okay, we want to buy calls. We will never pay more than $10 or $1,000 per 100 shares. Each option contract controls 100 shares. So if you look at this one, we paid 7.55, meaning if you're putting $1,000 in, that would only get you one contract in for $755. But you're still, look, controlling 100 Tesla shares. One contract controls 100 shares. That's 100 shares would cost you about 44 grand on a stock price of about 440 here. Just a hair over 440. We're buying the 452 and a half calls. A lot of people get confused and think, well, if it's a 452 and a half call and you paid 755, that implies that it has to get up around 460 for you to break even. That would be true at the expiration, at the end of the week in this case. But if we get that quick pop before then, you still have time value in your option, even as it pops in your favor. As you can see, the next day, the stock opens kind of flat line. We would hope to catch a little better of an open than that, but the reality is, okay, we know here's what we're targeting. We're targeting doubles. We're targeting 100% gains, and in turn, we're putting a 50% price stop. So we're targeting twice what we're risking in terms of our best case reward and our typical worst case risk. Obviously, gaps can exceed those parameters from time to time, but the idea is that look, this is why we put a 50% stop in there. Because look, intraday, Tesla pulled back that next day as low as about maybe 4 points or about 1% against us. And so the position could have been down 20 or 25% on a short-term option very easily. Okay. You don't want to put too tight of a stop on these, get flushed out like a lot of the other amateur traders out there and say, okay, then you get flushed out, then the stock rips to the upside. So by the end of the day, on that following day after we got in, October 1st, we're hitting our double target. Because look, the stock's rallied over 460. Remember what I said? At 460, it's $7.5 intrinsic value. If you're new to options, of course, you buy a call, you've got a right to own the stock at 452 and a half in this example, and it's at 460. Well, that intrinsically is worth $7.5 at 460, but it also has still at least 2 more days of time before it expires on that following Thursday and Friday, right? We're getting out on that Wednesday, October 1st. So there is another about $7.5 a time in this as well. So our 755 turns into 1510 per contract, a $755 profit on each contract or 100% gain on the amount you just invested. Your 755 doubles. If it had stopped down around 375 or so, we would have lost around 50%, right? So that's kind of the typical expectation of upside versus downside. If it doesn't do either, we will still time stop the trade at the end of that day on October 1st after we got in the day before. So in this case, you're never holding these trades for more than about 24 hours from one afternoon to the next afternoon at the latest. And you're never at the same time having a day trade because we get in so late in the trading day that our target or our stop's not going to hit in a matter of 15 or 30 minutes. It takes a little more time, typically off of a gap. Right? Remember, in all these examples, past performance doesn't guarantee future results. The next time we trade Tesla could be a winner or a loser, and that's just the case of any given trade and any given strategy. But our holding period here is, like I said, never more than a full 24 hours, one full trading day, without ever having a day trade. So you can do this with a small trading account even. And I don't know if you saw the news, but they're talking about reducing even for day traders the amount that you have to keep in an account. It used to be or currently at $25,000 or more has to be in there. Now they're talking about bringing that down to $2,000. So I think that's going to lead to an even bigger boom in quick strike strategies in the same day as well once they change that rule. But bottom line is that, okay, we're not just looking at one pattern. We're looking at several different patterns tied to gaps, tied to price action, and of course with that moving average filter to make sure we're on the right side of the intermediate trend as well. Kind of lining up two different time frames to both be on our side here. And then we're only going to buy a call if we're bullish. We're only going to buy a put if we're betting on the downside, because of course a put is a right to sell Tesla when we buy a Tesla put. And so the question is, which expiration do you buy? Do you buy this Friday or do you buy next Friday? And so typically what we like to do, if it's a Monday or a Tuesday, we typically are going to go out to the same this coming Friday's expiration. If it's and Wednesday, usually we would probably do the same thing as we know we'd be out by Thursday. But of course, if it's Thursday or Friday, we're going to go on out to the next Friday's expiration. Tesla has weekly options that often go out 6 or 8 Fridays from now. They have option expirations, but we're really interested in these first couple of expirations because we know we're not going to hold it into the expiration day. We're going to be out before then. So from this perspective, we're only going to get a potential new trading opportunity at the end of a trading day. And we like to get these trade alerts out around 3:30 p.m. Could be a few minutes after, but basically we send them out to real-time email, and it also you can get set up for real-time text alerts so that you can take advantage of this in real time. It only takes a matter of a few minutes. You log into your account, put in your whatever your dollar allocation you're putting in per trade, you know, okay, what my maximum dollar risk would be, then that tells you how many contracts you want to get. And so we'll show you more examples how that works. But basic premise is, okay, this saves you a lot of time. And guess what? It saves us a lot of time too, because we're not really worrying about Tesla during the trading day until we're getting into that final hour or less of the session, right? Because we've got a variety of other strategies that we're monitoring at different points in the day. And so this keeps our life a lot simpler to say, okay, for the Tesla strategy, we know as we come into 3:30, do we have a setup? Do we have a signal? We don't, no trade. We do, let's get the right expiration, the right strike price. And how do we choose our strike price? It's typically tied to how volatile Tesla's been recently. We look at something called average true range. So it helps us to kind of adjust to recent volatility. If it's been more volatile, we might pay a little bit more and be willing to pay a little bit more for an option. If it's been less volatile, we'll probably get a cheaper option. So it's all a function of recent volatility trends in Tesla. We're taking advantage of the power of not having to buy more time than you need, right? It's definitely not a widows and orphans strategy, right? There is risk. I mean, let's face it, you know, Tesla can move very quickly for us or against us. And so we have to be positioned to say, if you hit your 50% price stop, you're gone. If you hit your 100% price target, you take it. You don't try to hold for more, right? Sometimes gaps, like I said, can exceed our profit target or our price stop. But the idea is that like you're looking to rinse and repeat this with typically about 7 or 8 trades in a typical month, about a couple of trades a week is about what we're expecting. And that we're looking for, you know, plenty of these opportunities. What's interesting is you say, well, so what's my typical entry price going to be? Well, if you look back since the beginning of 2023, coming up in almost 3 full years of data, you see that our average contract entry price for a Tesla option trade was 5.65, $565 on average to control each 100 shares of Tesla stock, right? So the idea is that why aren't we buying cheaper ones? Well, because we don't want it to be too far out of the money where it would take too big of a move to get to our profit target. We also don't want to pay too much and end up losing leverage either. So this is kind of a sweet spot for us in that $5 to $6 range typically. Like I said, we'll always be out by the next trading day at 3:30 p.m. Eastern is our time stop, right? So if you haven't hit the price stop or the price target 3:30 hits the next trading day, you're seeing an email and a text alert going out say close it out. Here's the recommended exit price. Go ahead and make sure you get out before the end of that day for your exit that following day after we got in. So you don't want to be in a slow boat, right? The idea is that we're looking for speed, we're looking for price to move quickly, and when price action moves quickly, we're going to take advantage of it. When it doesn't, we're going to time stop it out. This is why we want to buy enough time to not get hurt too much by the loss of time. Because let's face it, when you're buying an option, time erosion is something you've got to manage. So you say, well, why should you care? Instead of just picking and choosing any individual trade, if you look back to all the trades we called out for Tesla options traders on our system and our trading going back to the beginning of 2023, If you started with a five, or in this case, actually a $25,000 model portfolio, and say you're putting in 5,000 bucks a trade without ever compounding it higher, even as the portfolio grew, you can see that it would lead 25,000 turning into 119,000 and change, a $94,000 plus gross profit. That's gross before commissions and before subscription investment. But if you're buying one contract, in this case, you'd be buying more contracts. You'd probably be buying, in this case, probably closer to like between 5 and 10 contracts a trade. But even if you bought 10 contracts in a trade, if it was 500 bucks a piece, well, that would still be 10 bucks in, 10 bucks out on your commission, maximum of 20 bucks round trip commission in that case, even if you got more contracts than the typical few. So the idea of this is that, okay, that was a pretty healthy result. Remember, though, looking backwards, that past performance cannot guarantee future results, right? Future results are going to vary. Your job becomes to not vary in your consistency of your execution. Know what your maximum dollars at risk that you're willing to commit are, and then never exceed it, and then just keep on executing through the highs, through the lows, through the times where you win, through the times where you get stopped. It's part of the game, and your job is really to be more consistent in your execution. We take the heat on basically making sure that the system is working, right? That the system is doing what it should be doing. We can't guarantee any one trade or any series of trades, but the idea is that we know subscribers are going to be happy if they're doing well. They're not going to be happy if they're not doing well, right? So we feel that gain and that pain and want to make sure that you're feeling a lot more of the benefit, and we're managing the risk so that your job becomes a lot easier to just focus on execution, right? If you can just focus yourself on execution, you save yourself a ton of time. No more screen watching all day. No more worrying about what do I do next. It's just really about, okay, there's my alert. I get in. I'm going to take this amount of risk. I'm going to go ahead and put this trade on to buy X contracts, and then I know I'm targeting a double, and I'm putting a 50% price stop in there. So you can see what that grew to, again, with the reminder that past performance cannot guarantee the future. Now, you can scale it up or down accordingly as well, of course. Trading is scalable. It's one of the great things about it. I always encourage new subscribers to start small and let the system prove it to you, and then you can gradually scale up. So we're not just looking for one pattern, but actually three different price action patterns tied to gaps and candlesticks. Two of those three patterns are bullish, and one of them is bearish, right? We know the moving average filter's got to also be there to make sure that we're going to see that pattern validated by being on the right side of the intermediate term trend too. Now, guess what? If we're not seeing one of those three patterns, then of course we're never forcing a trade. There's a number of days where it might come close but no cigar, and we just say, okay, no trade is viable here. So part of trading success, again, I've been trading for 36 years, is knowing when not to trade. Okay, everybody wants to tell you, hey, put on all these trades, get in the game every day. No, part of good trading is knowing when not to get in the game, when to take a step back. Remember at the start, I talked about keeping yourself in an opportunity mindset, not in a problem mindset. If you put on trades that you shouldn't have put on, you're going to kick yourself. You're going to beat yourself up psychologically. You're going to say, why did I do that? You need to constantly be building and protecting your confidence and your conviction in what you're doing. Okay. And so you're going to have times where it doesn't work. And the idea though is that if you're like, that's part of the system, then you follow the system. And so now you're committing to following the system. If you don't make that commitment, if you say, oh, I think I know better, I can pick and choose, I'll pick the right ones and I'll get rid of the bad ones, then you're really not following a system. You're back to the same ego-driven, I think I'm better than the rest, and therefore I'm going to think I'm right all the time, and therefore I'm going to have a hard time taking losses, managing risk, and that's going to get you back into problem mindset, right? We want to break you out of that cycle and get you into clean them up, move them on, get next opportunity, next play, right? Next trade. So the idea here is that, well, I'm not giving away the settings here with this introduction. You get those settings when you become a subscriber. We give you all the details. It's not a black box. Like I said, we're using a simple moving average, which is just filtering which direction has Tesla been going in general, right? And you can have, by the way, you can have all the opinions you want about Tesla, about Elon Musk, about is Tesla, going to, is it going to dominate this robotics, which is really a more of where the stock's being valued, or is it behind? Is it going to stay behind? And so you can have all kinds of opinions. My view is that Tesla moves a lot, right? And so from a trading perspective, whether it moves up or whether it moves down, I don't care as long as it moves, and as long as our system is driven to take advantage of it. So we're not so opinionated about whether Elon is going to win the robotics war, the EV war, whatever, right? I mean, so the point is that the stock, even with all the media negativity and a lot of this year, stock has done very well, right? And so it's one of those where it's like, okay, let's not get caught up in the headlines. Let's get caught up in what the price action. Price action in the chart is the ultimate tell of, are the institutions buying it? Or are they selling it? Or do they want more of it? Do they want less of it? Right? So that's your job, and is to execute what our job is, which is to tell you, okay, which direction it looks like it's headed next. So these price action patterns are definitely rigorously tested. We've put them through a lot of years of data testing and trading. And then with bearish trades, we do require a little bit of extra confirmation because we want to make sure that we're filtering out noise, filtering out fake outs as much as we can, right? So let's look at some more trade examples, bull and bear, and you can see. Now, this is an interesting one from this past month, back in September, when the stock had been kind of consolidating. You saw how it was trying to even break the moving average there for a couple of days, right? And you go, is that a bear signal there? No, because it's coming back up, and we're hovering right around it here, so we don't take a trade on either of those days. So you see, then we retake it, right? We retake it. And then you see that we get a little pause here, but look what happens. We actually traded on this day. We actually traded on the day before too. I think we've got another chart on the day before. So we caught a good part of that spike up in Tesla in mid-September. That was a Friday afternoon. Of course, we're buying the next Friday's expiration. So we were buying the September 19th monthly options that trade like weeklies with about a week to go on that Friday, September 12th. Stock was trading, as you can see, around 395. We're buying the 405 strike calls about 10 points out of the money. Now, then we paid 725 bucks is our average entry price per contract. Okay, so if you're putting 1,000 bucks in, that's only one contract. Fine. Point is that we bought that, and then right after the close and over the weekend, it was announced that Elon Musk, that prior week, which might have caused a couple of those big spike bars, Elon had bought almost $1 billion worth of Tesla stock. And I often say that big corporate insiders will sell stock for a variety of reasons: estate planning purposes, diversification. I mean, you see it with Jeff Bezos, you see it with Jensen Huang of Nvidia. And the idea is that that doesn't mean that they don't like their stocks. It just means that they're trying to create some diversification over time with just some free, gradual, tiny, for them, pre-selling of their position very, very slowly and in small, tiny increments. That's not a bad thing necessarily, but what's a good thing is insiders buy for one reason and one reason only. They think their stock is going a lot higher. They want to own more of it, right? And so Elon buying almost $1 billion worth of stock was his first insider purchase of that kind of size since in 5 years. I think it's since 2020. And you see that the next day, that on that Monday morning, it gaps up, right? Because the news is Elon's buying stock. And so it's kind of like when Warren Buffett buys stock. It's like the stocks get a lift. Well, Tesla got a big lift. Stock had finished around 395. It opens around 423, right? So it opens about 28 points higher. We're ringing the register on that Monday morning right off the open. You see that when it's up there around 423, we've got a 405 call. It's about 18 bucks in the money. There's still time value, right? Because the options don't expire. We're getting out on Monday morning. They don't expire till that Friday. There's still another 6 bucks and change of time value. And you can see here that then we're going to get out at $24.50. We were expecting to get out 14.5. So it made us an extra $1,000 a contract. So they're making 725 a contract. We made $1,725 a contract, which is more than the triple, 237% plus gain from a Friday in the day to the Monday morning, right? So you were in that trade, obviously you had the weekend, right? But the idea is that in market time, you're in that trade actually for less than an hour, right? When you think about, you're getting the last half hour on Friday, you're out at the open on Monday in the early opening minutes. And so you're not in that trade very long at all. And so it's one of those situations where, yeah, we want to take advantage of it. Like we said, we were in the day before that too, right? Here's the one the day before that, right? You're seeing we're closing almost at the high of that, down that huge, big positive candle. It had also gapped up. We do like gaps up as well. It's another part of a pattern. The part day's close was down here, and then it opens higher up here, and it just keeps going all day. A lot of people would tell us you've missed it, right? You say, but you're getting in here by the end of the day at the close. Yeah, we are. Just under, in this case, just under 370. And you can see that we're buying the 377 and a half calls. They're about 2% out of the money. And the next day, it goes from just under 370 to as high as about 387 and a half, right? So it's we bought a 377 and a half call, about 8 or 9 points out of the money, and you can see it rallies some almost 20 points, right? And so it gaps up, keeps going, and we get out during the day for our 100% profit, right? $586 in profit per contract. Now, if you're putting $1,000 in, you still only get one contract, right? That's okay. If you're putting $5,000 in, of course, you get something like 8 contracts for about $4,700 or so, right? So the idea of this is that it's all about focusing on whatever your risk is per trade, you'd be consistent in taking that. And just because we had those two big winners in a row, we remind subscribers, look, don't now load the boat after two big wins and back-to-back days and say now we want to double up or triple up on the next trade. That's not the secret of long-term success. The secret is to keep on being consistent in your capital allocation. So go back then to the following week after there's those two big pop-up bars. And by the way, you see when we got out of the open on that Monday, it was a good thing because by the end of the day, it closed quite a bit lower, right? So taking that bird in the hand, locking it down was the right thing to do. And it is the right thing to do, even if it kept going higher, right? You've got to have a plan on how you take money out of the markets. You've also got to have a plan on how you manage your risk. So now it's in a slow kind of grinding uptrend, but it does gap up and close up here on this uh, following Friday. That was September 19th, Friday afternoon. Here the stock's finishing the day around 425. We're buying the next Friday's week four, fourth Friday of September was the September 26th expiration. So again, when we're buying it on that Friday, the 19th of September, we've got another week to go before the expiration. And again, we paid 720. So again, over $5 means we only get one contract on $1,000 invested, $720 a contract. So we get in. You see the next Monday morning, it gaps up and trades to higher highs, gets up here to about the 445 level. Remember, we'd bought 437 and a half. So it might be worth about $7.50 intrinsically, but we're out at 1440 near that high because there's still almost a week left or 4.5 trading days left of time into from that Monday midday into the Friday, right? You see, then it reverses back down by the close, right? So we're glad to take that bird in the hand whenever we get it. When you go back and look at your trades and you say, how many times have I taken it at a profit target? Would that have been a better thing than if I let the trade run, right? There's a couple different philosophies there, right? One is let it run. What I find is that a lot of traders have trouble when a trade has run and then it rolls over on you and you go, well, I hate to say I was up more and then it rolls over on me and then now I've got to get out having left profit on the table. And so they have a hard time closing it. They think, well, if it gets back near those highs, then I'll sell it, right? They have a hard time closing it when it starts to roll over. I'm more of a kind of like try to take the bird in the hand rather than waiting for the two in the bush, right? I'd rather try to make sure that, okay, if we can make doubles, if we can keep our risk at 50% loss, we've got twice the size of reward to risk. We don't have to have a massive win rate to make that work. Even if you were 50-50, right? You think 50-50, that's like a coin flip. But you go, if every time you flipped a coin, and say you called heads every time, if every time you call heads, you make $1,000. If every time you get tails, you lose $500. Would you play that game where you could lose $500 on a coin flip? Yes, I would. If the other half the time I can make $1,000, I make twice what I'm risking. That will look really good, right? Because you make 1,000, lose 500, make 1,000, lose 500. That adds up to an average expectancy of on each two coin flips on average making a net of $500 divided by two coin flips. It would mean every coin flip's worth $250 in your pocket if you can just follow that system consistently. Now that's an example, right? I'm not saying we're going to do that exactly. There's going to be variability and sometimes better, sometimes worse. But the idea is that you've got to have that kind of consistency of saying, I'm going to follow this strategy. The worst thing you could do is if you did a heads tails game, so if you called heads 10 times in a row, And what if you went through a streak where, you only won 2 out of 10 times just out of some randomness at a bunch of tail scam. The worst thing you can do is then switch and start calling tails, right? You've got to be true to your system. You got to be true to your method and saying, okay, unless something has dramatically changed, you've got to handle the bumps in the road by continuing to execute and letting that edge still play out in your favor. So that was another one that doubled. Here's another one where, we waited until we came back above the moving average, right? That was right at the start of September. Remember, the markets gapped down at the start of September. Everybody's worried about that weak jobs data. They're worried about a weak September seasonality. Of course, the stock market ended up ripping to the upside for September and October as a whole, right? So it's kind of blown away the conventional wisdom, how strong this market's been in general. And Tesla, of course, has been part of that. But you see, now we're getting that nice gap up and close up, we're and above the moving average again. So near the end of that day, we're just about 338. We're buying a 342.5 call, right? That's pretty cheap, right? Only about 1% out of the money. And you can see we're going out to the next Friday. And so, how's it so cheap? Because it's kind of had this little consolidation, this little kind of tightening up of the price action over those prior several days. And so we bought it for 595 bucks, right, per contract. Next day we get a gap up. It's started at 338 that afternoon. Next morning it opens 348. It's up 10 bucks. It trades almost 16 bucks higher, right? Maybe 18 bucks higher, up to almost 356. So again, that 595 is turning into 1190, taking down $595 of profit per contract on those doublers. And so how about the downside? The downside, you see, guess what? We needed to break below the moving average and break below it with a strong negative finish, a very weak close, you would say, finishing near the lows of the day, right? That's what that red candle says. We opened a lot. And by the way, we gapped down versus the prior day's close, right? So we gapped down and we keep on trading lower all day. This was significantly further back in time when the stock was in the 160s, right? But the idea is that, look, it was about a $3.80 option that we entered. So you look at these and you say, okay, what's the percentage of the stock cost? That's about 2% or two and a quarter percent of the stock cost, right? So you're controlling at $162.50 strike put. You're controlling that 16,000 plus that you would pay to short 100 shares of stock for just 380 bucks. And so you see the next day it does gap down and we get out soon after that gap at 101%, take the money and run. We try again on another gap down there a few days later. This one didn't fire as well, right? So this is where the time stop kicks in that following afternoon, right? We get in with a stock near 150. We're buying a little bit more expensive option on 143 strike put, right? Because as the stock drops that fast, you're going to see volatilities pick up and the pricing of those options will get higher. And that's okay. We bought it at 395. Next day it trades from 150 down to about 146 and change. By the end of the day, it's 147. We've dropped about 3 points and we made one of those 3 points, right? You see that would imply that we only had about a delta of about 33%. What does that mean? It means that we just picked up about 1 point of profit for the 3 points that the stock moved in our favor to the downside. That's okay. I mean, 25% gain, we just say, okay, we gave it a chance, we'd take it. You never hold and hope for more a following second trading day after. You just take that next trading day. That's your window. When that window closes at the end of that following trading day after we got in, you say, now I'm out. So you're never holding it too far. The time stop really helps us a lot. You can see here's another example where you go, hold on, this looks like it reversed back up. Why would you get bearish on this one? Because it gapped down and it closed down from where it was the prior day, right? So the idea here is that we saw that we wanted to bet on a downside continuation as we're below the moving average, gap down, close down, and it finishes around 375. We're buying a couple percent on the money. We're buying 367.5 strike puts into the following Friday. That was on a Thursday afternoon. So go to the following Friday's expiration. We paid 965, right? They weren't cheap, but you can see that the next day it trades on down to about 365. So we're right about 10 points here, and we get about 4.1 points of that, right? About 41% of that 10 points. We make $410 as the option goes from 965 to 1375. 42 gain and the time stop kicks in. You go, oh man, you would have made more if you'd held on the next couple days. I don't care. You have a time window. If it didn't move as much as you had hoped or thought it would, you say, okay, well, it's time for me to close it out because you can always get back in. And when we get back in, we will adjust our strike price. We may adjust our expiration, right? We want to continue to kind of come into each new situation, each new trading day with a fresh outlook. Like even if we just close one out today and look at this afternoon as our next action point at 3:30 here in about 4 hours and go, okay, I want a fresh opportunity mindset. I don't want to be thinking about what happened on the last trade. I want to be looking at what the setup is now in this new moment, right? All we have is this moment, right? What's past is past. What's to come is for later, right? We're in this kind of day-to-day present moment kind of awareness, the power of now. Uh, Eckhart Tolle, I think, wrote that one, right? Really, really good stuff about getting into the present moment where there's a lot more peace, a lot more presence, and not being stuck in these past and future dramas that our mind may want to play out, right? So it's just like being present in the present moment, very valuable. Look at this, an average of just 7 new trades a month. So we're not expecting massive frequency, right? But we want to trade the best of the best. This was a year ago now, early November last year. This is the election, right? We just had, of course, election results for New York and other places last night. But the idea is that, look, this was right in front of the election. Now, we told subscribers this was like an earnings report, kind of a risk reward. It was going to have more potential upside, more potential downside. But what's fascinating to me about this one is the very first flip back up after we'd had 6 prior down days, right? Remember, we didn't trade any of those down days. And you go, man, you could have made some money on the puts. Too risky in our view because why? We're above that blue moving average, right? That just takes us out of trying to fight the intermediate trend. We want to get you tuned up and in tune with where the stock is more positioned to go, which you can see in retrospect, that was a really good thing, right? If you were making money on the downside in little drips and drabs, you probably would have felt like, yeah, the stock's going down. Why would I ever get bullish on this thing? It's been down 6 days in a row. Well, guess what? The next 5 days up were phenomenal, right? This is, of course, the first gap up on the earnings, the other election, right? The election victory for Trump. Stock has a big gap up because everybody knows Musk spent so much to help him get into office that they figure Musk is going to have a pretty prominent position to really make things well positioned for Tesla for a long time to come. So it gaps up. Not only is it, and we make way over our double, we make 397%, right? That was definitely an outlier, right? If you'd bought 2 contracts for 475 bucks a piece on your $1,000 maximum commitment, that gets you into 2 contracts for 950 bucks. Those 2 contracts are cashed out for over $4,700, right? So that's more than a $3,700 profit on that. That's that basically 5 bagger. Very unusual, right? Don't expect that. That's an outlier. But you say, okay, what if you missed that? Well, guess what? At the end of that day, we got back in to another trade. We bought the 290 calls at the day after the election, where a lot of people would say, oh man, it's already done its thing. Well, guess what? Still finishing strong after a positive gap up above the moving averages. We go back in when the stock's what? Right near just under 290. We buy the 290 calls. Those are a little bit more, 525. Next day, we're out at the double at 1050. If that wasn't enough, we get back in again by the now just under 300 by the 307 and a half calls, a little bit out of the money, paid 570. Notice how the options are getting a little bit more expensive because the stock's going gangbusters, kind of melting up, right? And so the idea of this is that, yeah, we're taking advantage of that. 570 goes to our double target yet again. And if that wasn't enough, we get into that near 320 again on the end of the day on the 8th, we buy the 337 and a half calls with the stock about 325, and we paid a little more, 625. Those more than triple when the stock gaps from 325 at the close here, opens up here near 345, right? So we're ringing the register right off of that bigger than expected gap, 20 points higher. We're making, you see, about 15 and a half points in the option, 248% gain, right? That's unusual to get that many day after day after day buy signals, but hey, in the power trend modes, we can get those. And that's why I said we can take the profit that we have in one, cash it in at our target or better, and then get back to the sidelines and then reset for the next afternoon and re-evaluate each afternoon, day after trading day, every trading day of the year, right? So the idea of course, what do losers look like? Here's one where we thought, hey, we're getting a nice reversal back up. We think that this is one that can have a good flip for us to the upside. And then instead, what happens? It gaps down and keeps trading down all day. We'd paid 570 for an option. If you paid 570, you stop it out down 51% at 280, you lose 290 bucks plus your round trip $2 commission on a contract, right? $1 in, $1 out per contract. So you lose like, $292. It happens, right? The idea is that we want you losing smaller and potentially winning bigger. That's the way we want you thinking about these. And like we said, some of times our 100% targets get gapped past. Here's another one where we're above our moving average filter, right? So we're not taking any of these down days, but as we see the positive reversal back up right near the end of the day, stock finishes around 322. We're buying 330 calls, about 3% out of the money. We paid 710, and that's on a Friday, so we're going out to the next Friday's expiration. 710, we're looking for 1420, right? It opens after getting in near 322, it opens around 340, up about 18 points. We get about 10 and a half of those 18 points. We're out at 1765 for 148% or $1,055 in profit per contract purchase, right? So the idea of this is that, okay, no matter what your allocation is, remember, we'll never put in more than $1,000 for an option contract on Tesla, never more than 10 bucks the way they're quoted. So that means if you're putting in $1,000 a trade, you can at least get one contract. Like we said, now in this example, if you're using 5,000 bucks a trade, start with a $25,000 portfolio, and as it grew from 25 to 119 in the last just under 3 years, we never allocated more than 5,000 bucks a trade. There was no compounding in the amount invested per trade. So I like that fixed dollar allocation, whether you're doing 1,000 bucks a trade, 2,500 bucks a trade, 5,000 bucks a trade, whatever your comfort level is. The idea is that be consistent. Say, I'm never going to risk more than that on each trade, and you're going to do that for, say, at least 3 months at a time, so you can kind of evaluate how it's going. So with that concept in mind, is saying give it some time to kind of start small and let your confidence build as you get comfortable with the system, comfortable with the methodology. As part of this Friendsgiving special event, I wanted to do something really special to give my thanks for how good David and Anka and the team have been to include me in these events. We're going to let you have not 1 but 3 months of Tesla Options Trader at a super deep discount. Okay. Normally, if you're buying it off of my Big Trends website, you'd be paying 297 bucks times three. So you'd be paying 891 bucks for 3 months. I'm going to slash that for you, so stay with me. But look at what else you get. You get everything that a longer term subscriber would get to the service. You get the settings and rule sheet. Part of our terms of service when you get signed up is that you do not share that, right? This is just for subscribers benefit only. I do weekly video training. I also give you access to me and my analyst team if you've ever got a question about Tesla options trades that we call out. Okay, so like I said, 297 a month for 3 months or 90 days access, 891 value. But what I'm going to do is I'm going to slash that with those educational bonuses down from 891, drop more than 700 bucks off of it, take it down to only 177 bucks to try it for the next 90 days. You think about that. You think that, why did I do that? Well, because I thought, well, that's about $2 a day. If you break it down, that 90 times 2 would be 180. So taking it down to under $2 a day, and you also look at it like, well, how many trades are you going to potentially get in the next 3 months or 90 days? We said about 7 a month. So that'd be about 20 or 21 trades. Expect about 21 trades in the next 3 months. That would be, of course, less than $10 per trade on trades that we showed you a bunch of them that can potentially make you thousands, or even if you're just doing 1,000 at a time, that you can still have the chance to make, 600, 800, potentially $1,000 if you get your full thousand invested on a doubler. Sometimes they get past that, but the idea is that I want you to experience how much the service can benefit you and let the system prove it to you. Don't just take my word for it. It's a small investment to make for just 177 bucks to be really getting laser focused, right? To really take advantage of this. So where do you go for that? We set this super special link for you here. It's members.bigtrends.com/giving. We're giving you a super special as part of this Friendsgiving opportunity with all the great presenters and fellow traders here. What I'm a big believer in is keeping it simple. So everything that you've seen here today is all about a pretty simple approach, right? There's no spreads, there's nothing complex about this. We're only going to be able to make this available for the first 25 traders. Service is nearly full, but basically I want to make sure that you take advantage of it before it gets closed down here. When you go to our order pages, they're really easy and simple. We've already taken all the discounts, so no other promo codes apply here. You see, we spell it out. When you get signed up today, you're getting 3 months of trade alerts. And our very next trailer could come as early as this afternoon at 3:30. Now, while I've been talking, Tesla's rallied more. It's up about $7.50. It's almost $452 a share. And so, we're looking at some, building potential positivity. But again, we've got some more time to go before we get to that 3:30 potential action point here in about 3.5 hours. So what you do is you go to that page. You can see that if you got any questions, you can call our 800 Big Trends number that's spelled out right there at the top right, or you can email my customer service team via client care at bigtrends.com. If you got any questions, just tell them you saw this super special discount on the Friendsgiving offer here. What you do is you go down here, you review our terms and conditions, which are spelled out how we've been doing business now for 26 years and counting. I launched bigtrends.com in November of 1999. And I'd made a lot off of the tech bubble back then. Sure, we've had another tech bubble with AI. Is it over? I don't think so. I mean, the bottom line is that bubbles can inflate a lot further than anybody could expect. And then when they collapse, they can give you a lot of downside opportunities too. So I'm a big believer in learning how to trade them both ways, to the upside and to the downside. You review the terms and conditions, hit the agree button, and then you can either, that's a secure page. You can take any of the major credit cards, put your payment info in the credit card box there, and fill out your billing information over on the left. Make sure you get your email that you want your trade alerts sent to, and we'll send you a follow-up instruction on how you can get set up for text alerts too. Or my preferred way to go is just using PayPal. You can click through on the orange PayPal button down the bottom right and go lock it down with just a few clicks into your PayPal account on how you want to fund it and lock in 90 days. It's not set up for an auto bill, so you just try it for the next 90 days. I think you'll like it and be pleased enough to want to go ahead and turn into a longer term subscriber after that. Some of the frequently asked questions we get is, what's our option strategy? It's keeping it simple, right? It's buying a call when we're betting on the upside. It's buying a put when we're betting on the downside. Why wouldn't we do spreads? Why wouldn't we do option selling? Because we're betting on a big move, right? Our patterns are set up to find a meaningful enough move that you can double or sometimes better your upside opportunity when it's gapping up, or when on a put, it's going to potentially gap down and trade still lower, right? We use these filters to really line up these patterns for your benefit over time. We'll send the trade alerts to your real time via email. Like we said, the entries come in around 3:30 p.m. Eastern with about a half hour to go. That's enough time. Say it only takes you a few minutes to get logged into whatever options platform you use or like to use. It's not platform dependent. Any trading platform you want to use is fine. We'll tell you, buy this option up to this price, pay no more than X. We might say pay no more than $8 or $800 a contract. And then we'll also send a follow-up text alert at the same time the email goes out, so you never miss a trade alert with a couple delivery methods in, and also reminding you when to get out. So the entry at 3:30, no later held than the next trading day at 3:30 for our time stop if we haven't gotten to our 100% profit target or our 50% price stop before then. Okay. We've averaged about 7 trades a month looking back over the past several years, and we don't have day trades. So you can do this even as a small account trader. You can start with just know that if you're going to put in up to $1,000 a trade, you don't want that to be your whole account, right? You want to make sure you've got kind of comfort to say, okay, there's times where it will work and make those doubles, times where it'll hit the price stop, and your job is to keep executing through whatever happened on the last trade. Get into the new moment, the new opportunity mindset, not the past problem mindset or the past whatever glee mindset if you just scored a big winner. You don't want to get too high or too low. You just want to be consistent in your capital allocation. You can see our average contract entry price over the past almost 3 years is 5.65, $565 per options contract that controls 100 shares of Tesla stock. You also get the bonus educational resources here. I do weekly video training, so I'll go through what the market's been doing, what we think it's positioned to do going forward. And then you also get both our Tesla options trader settings and rule sheet, which gives you all the specific parameters. You can follow along at home. You can learn the system and learn how to do this over time if you want to yourself. But the reality is that we simplify things and really make you much more efficient with your time. And we also give you a special Tesla 8 high definition video strategy session that I recorded to kind of walk you through a bunch more examples, a bunch more of the details of the system. And then if you got any questions, you can reach out to me and my analyst team with a separate dedicated email that we give you as well. Remember, just one trade can easily pay for this many times over, right? We showed you that one that we had on Tesla that we didn't know the news until it came out that weekend that Elon Musk himself had been buying up to $1 billion worth of Tesla additional stock for his own benefit, betting on the stock's upside. So Wall Street liked that over the weekend, and then by Monday morning, it was gapping up from the prior Friday's close near 395, opening around 423 up some 28 points, and we rang the register on those $725 per contract, turned into $2,450 a contract for a 237% gain, more than a triple. And we're only expecting a double, right? If we get windfall gaps like that, we say, hey, any windfall above 100%, we take it, right? If it gaps past our 50% stop, we would still take it if it gapped down 60 or 70%. That can happen too. It doesn't happen that often, but it can happen. You should plan for it to happen from time to time. But the key is that this is the power of options buying. You can make multiples over what you're risking. And so that's the benefit as an options buyer of leveraging the fact that you've lost very little time and you've taken advantage of a big directional price move in your favor. If you came in late, we showed you that a $25,000 starter model portfolio at the beginning of 2023 would have grown through today on all closed trades up to like 100 and was that 119,000 and change, a $94,000 plus gross profit. That's gross before commissions and before subscription investment. But our subscription investments are really reasonable relative to the potential that you can earn over time. And of course, the commissions have come down dramatically from what they used to be when I got started in trading 36 years ago with options. Remember too that we're looking at past performance. Past performance does not guarantee future results. Future results will vary, sometimes better than this, sometimes worse than this. But the goal is be consistent in your capital allocation. Your job is to be consistent in execution. If you're consistently executing, it's going to make you a more consistent trader. You're not going to swing as high and low as you have been when you're trying to pick and choose in other systems, other approaches, other, what I would call ego-based kind of decision making. We don't want to have that lack of a system. We want to be very methodical, very systematic, very regimented in how we're applying capital to each trade consistently, not thinking that one trade is better than another on the way in. Just saying, we've got a signal, take it. If it don't have a signal, don't trade, right? So we're really clear cut for you. So like we said, 3 months, $891 value, but yours today for just 177 bucks. So there's your link. It's members.bigtrends.com/giving. That's also that members.bigtrends.com is actually where you're going to get a lot more membership benefits, including all your bonus educational resources, weekly updates from me on the videos about the market and Tesla, and basically also, of course, just a whole lot of support there. So members.bigtrends.com/giving, that's your link to take advantage of our Friendsgiving super special as part of this awesome event. So I'm going to go ahead and hand it back over to David so you can get ready for our next great trader and presenter. Thank you, David, for including me and wish you and yours a happy Friendsgiving and Thanksgiving. We're thankful for you and all your support, and happy early Thanksgiving to everybody out there.